Hey everybody, here's your market minute for Sunday, the 15th of October. Now in our trading, we use a lot of statistical analysis to put on our option positions, but in charting, we're using technical analysis to build a framework for how we should view the market. Now I know this is different from a lot of other YouTube analysts that love to make predictions. So predictions get a lot of clicks and they get a lot of attention, and people love to view predictions. What do you think is going to happen in the future? Well, guess what? Nobody really truly knows what's going to happen in the future. What I prefer to use technical analysis for is to build a framework to allow me to make decisions based on what's going to happen. Let me give you a for instance here. So back in the early July timeframe, we talked about this being a decision box, right? Because we had the price coming up to here to make a new high. We pulled into a higher low, and then we had an equal high. So a lot of people would say, oh, that's a double top. It's going to reverse. So they would start to short the market at that point. Now, the problem with that is that neglects the strength of the trend that we had up to that point. So myself, we were like, hey, let's just draw a decision box around here between this high and whatever low that shows up here. And then we know that if the price breaks above here, we have a continuation. If the price breaks below this box, then we have a reversal. So that might be nice to know, and it was worthwhile to wait on and not just trade in front of that. Now, something else, just to give a little bit of color to that, we did have a lean to this because this was starting to show a potential ascending triangle pattern, which is a well-known pattern. If we had a break above that level of 44.50, then we more than likely had a breakout happening from that point. So you can start to frame in the problem and then add some color to this, like with the chart pattern that we saw. So now we have the same thing. We have a series of lower highs, and this is a weekly pattern. So this is the weekly chart making this pattern. Lower highs and lower lows. So we have a downtrend on the weekly chart. Rule number one says that larger time frames dominate the trend. And so this is why we're seeing every little rally that happens on the daily chart is getting faded back down. And this one appears to be no different so far. So what we have is a potential fork in the road. Either the price can do one of two things. It can follow this weekly trend to the downside and then maybe hit one of our targets that we have down here. Over the past few weeks, I've talked about targets of 4,200, 4,150, which is more of a volume profile target, and then an Elliott wave target for the C 1.618 wave down here at 4,100. This would also be about a 10% haircut. So far, we're about 8% with the move to the downside from the late July highs, about 8% so far. We could go the full 10%, which is today's definition of a full correction. Either way, this has definitely been a correction. It's just a matter of how deep we get and how negative the sentiment will have to be before we find a reversal point. So now what we need to do is we need to find the structure that will help us understand whether the price is breaking higher from this point. Is this the beginning of a big swing to the upside, or is this just, as we said, a move to the downside just beginning? Well, something that can help us understand that, if we zoom in on this area, and if we draw the fib retracements from here, this is something I've always found to be very useful in terms of building the structure around something. So far, from the bottom to the top, we've had this move, which has been good for some 170 points or so. And so it's very normal to see retracements of 38.2%, 50%, or as deep as 61.8%. Now, the 61.8% retracement effectively becomes the last line of defense for the bulls. So in other words, if this trend is going to continue to the upside, we need to hold 4280 on the cash index as support. And if we see a closing bar below 4280, then more than likely we are heading lower. So that's the structure here. Otherwise, what we can assume is that any low off of here is going to be a higher low with the strong change in polarity at this point, and that we might expect to see a higher high. And obviously a break through 43.86 is going to signal that we have not only a higher low, but a subsequent break above that to create a change in polarity or an uptrend. So this is kind of the box that we're working off of at this point. We're bounding things by 43.86 to the upside, 42.80 to the downside, another 100 points or thereabouts decision box, or what we call a Darvas box, for how to view things going forward. Now, just an aside here, we have an IV percentile of 36 right now on the S&P, which is, if we look at the VIX here, if we look at the implied volatility, we have over the last 252 days, this value of 36 is on a scale from 0 to 100. So obviously, about a year ago, we had much, much higher implied volatility than we do now. So 36 isn't bad, and this is an area where we can definitely sell. Not long ago, we were at an implied volatility percentile of 0, which was back here. And that is a very dangerous time to be selling options. Now, not so much. We can actually be a little bit more aggressive with our trade entries because we're getting paid better risk premium for our trades. All right, folks, that is it for this weekend's Market Minute. Thanks for listening. We'll see you in the next one.